Alright, so as promised, I am providing this as a walkthrough for Chapter 1, Question 8a. As you can see on the screen, I've laid out a copy of the solution page, which has assets and liabilities, as well as the income statement related items. In my example, I did not indicate the month or the point in time of which the income statement is created or balance sheet. However, as you can see in the example, in this question, it is as of January 31st, 2019 for the balance sheet, or for the month ended January 31st, 2019. I've already taken the privilege of walking through and entering the opening balances. So again, if you look on page 8 of your workbook, it has the balance of cash at $9,000, the contents of home at $6,000, automobile at $29,000, etc. I have inputted formulas, which if you're doing this on paper, you would have to do the manual calculations. But what you want to do before you start any problem is actually validate that your opening balances tie in with each other. That is, assets equals liabilities plus net worth. So my formula at the bottom here tells me my total assets are $200,000. And my total liabilities 65.5 plus net worth for a total of 200,000 for those two categories. I've also built in a little sheet that tells me whether we are in balance or not in my Excel version. So in this case, we will walk through 6 transactions, and I'll show you how you would post these in these T accounts, in these general ledger registers. So the first item is a deposit of $4,040 from salary earned during the month of December. So if it was actually deposited, we know that the actual cash came in the door. Okay, $4,040. The reason why I'm putting in number 1 is because it's for transaction 1. It's always helpful if you're out of balance at the end to go back and be able to follow your transaction coding to see if you actually typed in a number backwards, transposed it, whatever that might be. It just helps reduce your search and destroy, search and locate the issues later on. And in this case, it is considered revenue of $40.40 again. So we'll increase the revenue for $4,040, which again, it's transaction number 1. Transaction number 2 says we paid maintenance expense with $120 cash. So this is transaction number 2. We paid $120 cash. Notice that my formulas are made to auto-calculate. You may or may not have that built. So it's a decrease to cash, and you paid a maintenance expense, therefore you're increasing your expense. So on the maintenance side, you have transaction 2, $420 as an expense for that transaction. Item number 3 says we purchased new furniture worth $2,500 with cash. So again, we're using cash, we're decreasing cash, and we're buying furniture for $2,500. In this case, because it has a longer term or a longer life expectancy, we will be adding this to the contents of home. So part of these transactions require you to consider what's the purpose of the transaction. Is it to buy something that has a longer period of lifespan, a longer life, therefore considered an asset, or is it a true expense? So if you were buying a box of pencils, I would suggest that that's a supply, an office supply, something that you would consume and therefore be considered an expense. In this case, because we bought new furniture, the hope is that furniture lasts you for many years. We will consider that as contents for home. Some of you may ask, what about depreciation? Assets lose value over time. Yes, that's true. We deal with that in a later chapter. Okay, so park that thought. Number 4 says we paid credit card liability of $5,500 in full. So again, point 4, we are spending cash, $5,500. It's the only way to pay off your unpaid accounts, so we're decreasing cash. And we are decreasing the amount that we owe our creditors. So therefore, it is a left side, a decrease of the liabilities. As you will know in the future, it is considered a debit. Item number 5 says we paid telephone, electricity, and water bills for January with $1,200 in cash. So it's for the current month. We're using cash, so transaction number 5, $1,200. And because these are utility bills for the current month, it's actually an expense for the current month. And transaction number 6 is we purchased $2,000 of groceries for personal consumption with cash. So in this case, we have transaction number 6. We purchased $2,000 with cash, so we're decreasing our cash balance. And this is a personal income statement, therefore it's personal food expenses. We're increasing our expense, which is the left side transaction, so 6 for $2,000. I just realized the format of that is not consistent. I will fix that. So now that we've gone through the 6 transactions, what I would always encourage you to do, if it's not done in the workbook, you will have to do this on your assignment or test, is you always want to make sure your titles are done right. So we will actually fix that, so you can see this in the completed version. So this is as at January 31st, 2019, as per the question. And it's for the 1 month, so just type month, ended January 31st, 2019. Okay, if you're using a manual spreadsheet, so you've done this in pencil, after you've posted these transactions, you will want to go through each account and determine what your subtotals are. So for example, all of your assets, you will add up the left side, the increases, take away all the decreases, it'll give you a total. If it's a positive number, it remains on the left side. If it's a negative number, that means your decreases exceeded your increases. It'll be a positive number on the right side, otherwise known as a credit balance, an abnormal balance. Okay. You would do this for each of your assets, and then total up your assets accordingly. In this example, I have $195,220. Similarly, you would do the the liability side, but it's the inverse, the opposite relationship, where liabilities have a normal balance of a right side, otherwise known as a credit. So you would take up all of the right side transactions, add them up, take away the left side. If it's positive, it remains as a credit balance, a right side balance. If it's negative, you flip the balance over to the opposite side. You do that for each of the accounts. You'll notice there were no transactions posted in net worth at this time, and that's okay, we'll come back to that. So the total liabilities in this situation are $60,000. I'll get back to net worth in a moment. As we go over to income statement, we now add up all our transactions for revenues, add up all our individual accounts for expenses. So similar to what we did on the balance sheet, each account should have a subtotal. We would then add up the revenue for the month, okay, which should have a right side, a credit balance. We would add all the expenses, which should typically have a left side balance, which is a debit. If you happen to have right side balances in your debit and in your expenses, they're actually a negative expense, so it would reduce your expenses. It is possible, and I'll get into some situations on a live session at some point. So in this example, we had $4,040 in revenue. We had expenses of $3,320 for a total surplus or deficit of $720 for the said period, ending January 31st. For the balance sheet component now, your net worth, we have not posted any entries yet, but your net worth at this point for this worksheet calculation will be the balance in your net worth account. Add any surplus or take away any deficit that you may have. So in this example, we'll have $134,500 plus the $720 to give us a total in this case of $135,220. Adding that to our liabilities, we are then in balance to the value of our assets, being $195,220.